Imagine walking into a grocery store on an ordinary morning. The shelves are full, the lights are on, nothing looks wrong. You reach the counter and pay. The transaction fails. Not because you lack money, not because the bank is closed, but because the system behind that money no longer accepts it. For decades, modern life rested on an assumption so deep it was never questioned. That money was neutral, that reserves were untouchable, that following the rules guaranteed access. That assumption did not collapse. It was quietly overridden. In the first weeks after the war in Ukraine began, roughly $300 billion in foreign reserves belonging to the Russian central bank and held abroad became inaccessible. No vaults were stormed, no assets were seized by force. Access was simply removed. Within days, markets adjusted. Energy still flowed, ships still sailed. Payments still cleared, but not always through the same routes. Some energy trades continued, yet settled differently. Some payments reached their destination by paths that had rarely been used before. Nothing broke, which is why the shift was so easy to miss, because the system did not fail. It revealed a rule that had never been written down. If central bank reserves can be disabled without war, what does financial safety actually mean? If energy can reroute without headlines, where does real power sit in this system? To answer those questions, the story must step back. Before the sanctions, before the adaptations, it must return to how this financial architecture was built, why it worked for so long, and what changed the moment neutrality became conditional. To understand why that moment carried such weight, it is necessary to step away from the shock and return to the structure that made it possible. For most of the modern era, money functioned less as an object and more as infrastructure. It was assumed to be available, reliable, and politically neutral. Nations held reserves abroad because it was efficient. Trade cleared through a small number of financial centers because those centers were trusted. Payment systems became centralized not by design, but by convenience. This architecture took shape after the Second World War, when stability became the overriding priority. Fixed exchange rates, reserve currencies, and shared clearing institutions reduced uncertainty in a fractured world. Over time, the system evolved, currencies floated, capital controls eased, financial markets deepened, but one principle remained largely untouched. Access was assumed. If reserves were held, they could be used. If transactions were legal, they would clear. If rules were followed, the system would function. This belief shaped decades of policy decisions. Governments accumulated foreign reserves as insurance against crisis. Central banks prioritized liquidity and safety over return. Corporations built global supply chains around predictable settlement and cheap financing. Efficiency became the organizing logic. The system rewarded specialization. It minimized redundancy. Risk was managed through diversification and scale, not through control of physical assets or jurisdiction. By the early years of the 21st century, financial globalization appeared mature. Capital moved freely. Payment systems processed trillions of dollars each day. Trade flows spanned continents. Crises occurred, but the core infrastructure held. What was rarely questioned was why it held. The answer was not law alone. It was restraint. Financial power existed, but it was exercised selectively. Sanctions targeted individuals, companies, or limited sectors. The underlying plumbing remained intact. Central bank reserves were treated as untouchable, not because they were sacred, but because touching them would undermine confidence in the entire system. This restraint created an illusion of permanence. Countries with deep political disagreements still shared financial infrastructure. Rivals cleared transactions through the same systems. Money crossed borders even when trust did not. But permanence in complex systems often depends on what has never been tested. When access to reserves was revoked, it became clear that neutrality was conditional rather than guaranteed. What had functioned as insurance revealed itself as contingent on political alignment. That realization mattered more than the immediate financial impact. It forced governments, central banks, and institutions to confront a question that had long been avoided. What happens when the infrastructure itself becomes an instrument of policy? The answer to that question begins with sanctions. The most powerful moment of the early war did not involve troops or territory. It involved access. The reserve freeze did not arrive as a headline event. It arrived as a realization. In the first trading days after the war in Ukraine began, the Russian central bank attempted to operate as it always had. Foreign reserves were meant to be insurance. They were held abroad for liquidity, safety, and immediate use in crisis. That insurance did not activate. Roughly $300 billion in foreign reserves held outside Russia were no longer usable. The assets were still recorded on balance sheets. They were not destroyed or physically seized, but they could not be moved, converted, or deployed. Money that cannot move cannot protect. This was unprecedented at scale. Sanctions had long targeted individuals, firms, and specific transactions. Financial pressure was applied at the edges of the system, not its core. Central bank reserves had remained off limits because they represented something larger than any single conflict. They represented trust in the system itself. What changed was not capability, but willingness. The reserve freeze demonstrated that financial infrastructure could be used directly as policy. No default was required. No legal process needed to unfold over months. Access was withdrawn through jurisdiction and custody. The distinction matters. Markets can recover from losses. Currencies can adjust to shocks. But once access itself becomes conditional, every assumption built on neutrality must be re-examined. Central banks around the world understood this immediately. There were no public announcements or dramatic reallocations. Instead, reserve managers began reviewing scenarios that had once seemed theoretical. What if reserves could not be accessed in the exact moment they were needed? What if safety depended not on asset quality, but on political alignment? Insurance that fails when it is needed most is not insurance. It is exposure. The reserve freeze did not break the financial system. It exposed where control actually resides. To understand why this control existed in the first place, the story must move deeper into the structure beneath global money flows. The most powerful part of the global financial system is not the currency. It is the switch. What made the reserve freeze possible was not a new rule written overnight. It was a structure that had been in place for decades. Global finance does not operate as an open field. It operates as a network. Cross-border payments move through correspondent banks. Reserves are held in custodial accounts. Trades settle through clearing systems concentrated in a small number of jurisdictions. Even when two countries transact directly, their money often passes through the same financial nodes. This concentration was not designed as a weapon. It was built for efficiency. The United States dollar became dominant because it was liquid, stable, and widely trusted. Over time, everything else aligned around it. Trade contracts, commodity pricing, insurance markets, and reserve management practices followed usage. Infrastructure grew where activity concentrated. The result looked neutral, but neutrality depended on restraint. As long as access was universal, the system felt invisible. Nations accepted reduced sovereignty over reserves because liquidity was guaranteed. Efficiency justified dependence. The reserve freeze revealed the trade-off. Control over clearing does not require ownership of assets. It requires jurisdiction over settlement. When access to custodial accounts is withdrawn, assets still exist, but they lose function. That is what happened. The reserves were not erased. They were disconnected. This distinction matters because it shows where power actually sits. In modern finance, influence does not come from printing money alone. It comes from the ability to interrupt flows. Once interruption becomes a policy option, the entire system must be reinterpreted. After the freeze, central banks did not ask whether the system would survive. It clearly would. They asked which parts of it could be switched off and under what conditions. That question reshapes behavior. Efficiency becomes vulnerability. Concentration becomes exposure. Liquidity competes with control. This is why the response was quiet rather than chaotic. Institutions began planning for interruption rather than assuming continuity. Contingency scenarios replaced trust-based assumptions. And when money becomes conditional, the physical economy cannot ignore it, because factories, ships, and power grids still need to operate. That pressure appears first where delay is impossible. In energy, energy never stops. It only reroutes. Energy is where financial theory meets physical necessity. Power plants must run on schedule. Refineries cannot pause without cost. Ships carrying oil and gas do not wait for diplomatic clarity. When payment friction appears, energy markets adjust immediately. After the reserve freeze, producers and importers faced a practical problem. What happens if payment clears slowly, unpredictably, or through channels that may suddenly close? The response was not ideological, it was operational. Energy continued to flow, but some transactions began settling through alternative paths. Different currencies were used, intermediaries changed, clearing routes multiplied, insurance and shipping finance adapted alongside them. There were no declarations of a new order. There was no abandonment of existing systems. There was only redundancy. Energy markets care less about symbolism than certainty. Producers need to know that payment will clear and remain usable. Importers need reliability more than alignment. When certainty weakens, diversification becomes rational. That is why energy adjusted first. Unlike manufactured goods, energy is continuous and essential. It cannot be stockpiled indefinitely at scale, and demand does not disappear during political conflict. Any friction in settlement is absorbed immediately, and alternatives are sought. These adjustments did not replace the dominant system. They reduced dependence on it. Each alternative settlement lowered exposure to a single channel. Each workaround weakened the assumption that one route was permanent. This is where financial leverage meets its limit. Sanctions can restrict flows. They can increase cost, but they cannot eliminate the need for energy. The result is coexistence rather than collapse. Old systems remain dominant, but no longer exclusive. Reliability begins to outweigh simplicity. Once energy adapts, the rest of the economy is forced to respond. Supply chains cannot function if payment, insurance, and energy access remain uncertain. To see how this pressure reshapes production itself, the story must now move downstream. When payment becomes conditional, supply chains feel it first. Energy was only the beginning. Once settlement reliability could no longer be assumed, global supply chains were forced to confront a vulnerability they had long ignored. Modern production depends not only on factories and labor, but on financing, insurance, and continuous payment clearance, operating quietly in the background. A single product often crosses borders multiple times before reaching the consumer. Each step relies on letters of credit, currency hedging, shipping insurance, and bank settlement. When any one of these layers becomes uncertain, the entire chain absorbs the risk. After the reserve freeze, companies did not wait for additional sanctions. They reassessed exposure. The central question was no longer who could produce cheapest. It became who could be paid reliably. Firms began diversifying suppliers even when costs rose. Payment routes were expanded. Inventory buffers increased. Some production stages were moved closer to end markets, not for efficiency, but for control. This was not ideological reshoring. It was defensive restructuring. The system had been optimized for efficiency under one core assumption: financial access would always clear. When that assumption weakened, efficiency turned into fragility. What followed was not a retreat from globalization, but fragmentation. Supply chains did not collapse inward. They reorganized into overlapping regional networks. Companies favored partners inside predictable legal and financial environments. Redundancy replaced specialization. Speed gave way to survivability. This shift carries consequences that compound over time. Fragmented supply chains are slower. They are more expensive. They embed geopolitical risk directly into prices. Consumers experience this as higher costs and fewer choices. Firms experience it as thinner margins. Governments experience it as persistent inflation and reduced growth potential. The reserve freeze did not raise prices directly. The adaptations designed to avoid the next disruption did. Once trust erodes, systems compensate with buffers. Buffers consume capital, labor, and time. Those resources must be paid for. This is how a financial precedent reaches everyday life, not through collapse, through drag. The global economy still functions, goods still move, production continues. But the system that once maximized speed now prioritizes resilience. And resilience, by design, is heavier. To understand how these structural changes play out across countries and regions, the story must widen once more. The system did not change for everyone at the same speed. It changed based on where you stood. The reserve freeze revealed a divide that had always existed but was rarely acknowledged. Countries closest to the center of the financial system experienced the moment as leverage. Countries farther away experienced it as exposure. In the United States and much of Western Europe, markets continued to function. Dollar liquidity remained deep. Government bond markets cleared. Payment systems stayed intact. From inside the core, the system appeared resilient. From outside the core, the lesson was different. A large share of the immobilized reserves had been held in foreign jurisdictions precisely because they were considered safest. That belief collapsed quietly. Safety was no longer defined only by liquidity or credit quality, but by political alignment and custody. A reserve asset that cannot be accessed during crisis is not insurance. It is conditional permission. This realization mattered most for emerging economies and commodity exporters. Many of these states hold reserves not for yield, but for survival. Reserves stabilize currencies, secure food imports, and guarantee energy access during stress. When access becomes uncertain, the entire risk framework fails. The response was global but silent. Reserve managers did not issue statements. They adjusted portfolios. Exposure to single custodial jurisdictions was reduced. Gold allocations increased. Some assets were shifted closer to domestic control, even at the cost of liquidity. This was not resistance. It was adaptation. The contrast with China sharpened the picture. China did not eliminate risk, but its architecture limited interruption. Capital controls reduced exposure. Settlement increasingly occurred within domestic or regional systems. Trade agreements bundled finance with infrastructure, minimizing reliance on global clearing hubs. The system was less efficient. It was harder to switch off. That distinction changed incentives. The comparison was not about ideology. It was about interruptibility. Which systems could continue operating if access were restricted? As these incentives shifted, trade behavior followed. Energy exporters aligned more closely with large, reliable consumers. Manufacturing hubs favored partners with predictable settlement and insurance access. Financial flows increasingly tracked political relationships alongside price signals. The global economy did not fracture into isolated camps. It bent. That bend has consequences. Fragmentation reduces efficiency. Redundancy raises costs. Geopolitical risk becomes embedded directly into prices. Inflation persists not because demand surged, but because trust now adds weight to every transaction. Consumers feel this as higher living costs. Firms feel it as thinner margins. Governments feel it as slower growth and narrower policy space. The reserve freeze did not create these pressures by itself. It accelerated them by revealing a vulnerability that could not be unseen. Once safety becomes conditional, adaptation becomes unavoidable, and adaptation always introduces friction. To understand how states and institutions respond to this new reality, the story now turns from consequences to choices. Once neutrality disappears, every system must choose how to survive. After the reserve freeze, the global financial system did not search for a fix. It searched for workarounds. No major economy can fully exit the existing architecture without severe cost. No parallel system is mature enough to replace it outright. What has emerged instead is a spectrum of adaptive strategies, each shaped by trade-offs rather than ideals. The first path is consolidation. Some states choose to move closer to the financial core. They deepen alignment with jurisdictions that control settlement, custody, and liquidity. Reserves remain where markets are deepest and payment systems most reliable. This preserves access. It also formalizes dependence. For advanced economies with strong institutional ties, this approach still works. Capital remains cheaper, financial markets stay liquid, but strategic autonomy narrows. Financial safety becomes inseparable from political alignment. The second path is diversification. This is the most widely chosen response. Rather than betting on a single system, reserve managers spread exposure across currencies, custodians, and asset classes. Gold holdings increase not as a statement, but because gold carries no settlement risk. Bilateral trade agreements reduce reliance on global intermediaries. Payment routes multiply. Diversification does not remove vulnerability, it dilutes it. Efficiency is sacrificed for resilience. Returns decline modestly. Friction increases, but catastrophic loss becomes less likely. Insurance regains meaning, even if it becomes more expensive. The third path is insulation. Some states reduce exposure by tightening capital controls and localizing settlement. Domestic payment rails are strengthened. Trade flows are routed through controlled channels. The cost is growth. Capital becomes harder to attract. Innovation slows. Domestic inefficiencies compound. Insulation protects sovereignty, but limits scale and integration. None of these paths is neutral. Consolidation trades autonomy for access. Diversification trades efficiency for resilience. Insulation trades growth for control. The most dangerous position is pretending no choice is required, because the old assumption has already been broken. The reserve freeze changed incentives across finance, energy, and trade. Once access can be withdrawn, systems must be designed to withstand interruption rather than assume continuity. This is why parallel settlement systems continue to expand, why supply chains remain shorter and more regional, why reserve management now considers custody and jurisdiction alongside liquidity and yield. The system will continue to operate, but it will operate under different rules. Speed gives way to redundancy. Certainty gives way to optionality. Over time, this reshapes growth, inflation, and living standards, not through collapse, but through the accumulation of small frictions that never fully disappear. The final question is no longer how the system works. It is who ultimately absorbs the cost of making it safer. Nothing collapsed. Everything changed. The global financial system did not break. That is what makes this moment so easy to misunderstand. There was no day when markets shut down and rules were rewritten in public. No single event forced an immediate reckoning. What happened instead was quieter and far more consequential. A boundary that had long been assumed to exist was crossed. Central bank reserves, once treated as neutral insurance against crisis, were rendered inaccessible through financial channels alone. Payment systems revealed themselves not as invisible utilities, but as controllable infrastructure. Energy and goods continued to move, but they learned to move through altered paths. Nothing failed. Everything adjusted. The world now operates inside a system where trust carries conditions. Access depends on alignment. Efficiency competes with resilience. Scale competes with control. For governments, this creates trade-offs that did not exist before. Financial integration still offers liquidity and growth, but it narrows strategic independence. Diversification restores resilience, but raises costs. Insulation protects sovereignty, but limits opportunity. For companies, the logic of production has shifted. Systems built purely for efficiency are being replaced by systems designed to survive interruption. Redundancy is no longer waste. It is insurance. For individuals, the consequences arrive slowly. Higher prices, persistent inflation, a sense that systems which once felt automatic now require constant awareness. Most people never think about custody, jurisdiction, or settlement. They only feel the outcome. Prices rise, stability fades, choices narrow. This is not the end of the global order. It is the end of a specific assumption within it. The assumption that money was neutral, that reserves were untouchable, that infrastructure could not become policy. Those assumptions no longer hold. Understanding this shift is not about fear or prediction. It is about awareness. Incentives shape outcomes whether they are acknowledged or not. The system is still running, but it is running with friction. And friction always sends the bill somewhere. If this analysis helped clarify how financial power now operates beneath the surface, share it with others who still assume the old rules apply. And if you want to continue exploring how money, energy, and geopolitics intersect beyond the headlines, staying engaged is how the conversation continues, because the rules did not disappear, they changed.